The US share market is vast. The US markets have giant technology companies such as Google and eBay, while the domestic markets are more inclined towards the stable types of companies such as resources. While as a beginner you may be safer placing spread bets on UK shares, your broker will usually allow you to bet on shares of other countries, particularly the US markets. If you're spread betting, there are no substantial differences between trading local UK shares and trading USA ones. What suits you best will depend on the time frames you can trade and the knowledge you have of the market, industry or company you're planning to trade. Suppose it's the 2nd of February and Apple is trading at 147.52. The two prices quoted are the bid and the offer. The offer is the price at which you can buy the stock and the bid is the price at which you can sell the stock. As some countries have a way of quoting prices which is different to others, spread betting providers have adopted the policy of quoting the price as a whole number and not splitting the pence or cents up with a decimal point. You check the spread betting company's price which displays the underlying market, and it's 147.48 to 147.54. This is a spread of 6 points. This is a daily bet, so will expire at the end of the trading day, so it's suitable for a trader looking for an intraday movement in the stock. 147.48 is the sell/bid price, and 147.54 is the buy or offer price. You decide to buy at £5 per point at 147.54. You will be making £5 for every point that Apple rises above 147.54 and lose £1 for every point that the price falls below 147.54. Over the course of the day's trading, Apple rises to 147.80 and you decide to sell your position and take the profit. Stocks traded on USA exchanges are more volatile than those traded on the London Stock Exchange because of the high volume of trades which create more volatility. For this reason, the spread betting providers who quote USA stocks may offer them at a wider bid-offer spread, or they might insist on higher margins. This is a way for bookies to discourage traders taking positions on very volatile markets. To work out your exposure to a stock is a very simple calculation. It's the buy price times the stake you choose. If we take a minimum stake of £1 sterling times 41497, your overall exposure will be £41,497 worth of stock. That's just over $70,000 worth. You never have any currency exposure unless you are trading the currency itself. The bets are always placed in your base currency. So if your stake is in pounds, your profit and losses are also realised in pounds, effectively meaning that your position will have no exposure to forex rates. Most people just trade in pounds to keep things nice and simple.